Hello, everyone. Welcome back to the Daily Gold YouTube channel. Welcome to the Daily Gold podcast. With me today is returning guest, one of our favorites. He is Greg Weldon. And by the way, this is being recorded on Friday, January 17th, 2025. Thank you so much for tuning in. And Greg, I want to give you kudos because I believe the last time I had you on, maybe last spring or maybe it was a little bit before that, and you were talking about gold is going to, I believe you said 2,700 or 2,800. You had a target somewhere in there. You absolutely nailed it. So kudos to you on that. That's why I wanted to have you come back. It's also the beginning of the year. So, Greg, starting off, I do want to talk about macro in the macro economy because we've had this discussion the last few years. The economy's been relatively weak, but it's been holding up. They've been able to prevent a recession, at least statistically. Uh, I know it's hard for me to ask you a big picture question because there's so many different details you like to focus on. But um, yeah, big picture with the macro economy, what do you think is the outlook this year?
Well, do you have 2 or 3 hours? And maybe we can cover some of it. But I will say first, I don't want to exaggerate our call last year. Yeah, at the beginning of the year when gold was well below 2,000, we said 2,650, and it seemed outrageous when we said it too. And we got some people that are like, "Okay, you're just a gold bug," which of course I'm not. And yeah, it went to 2,800. So that was a good call, but we did not call for 2,800. So I don't want to mislead your people. In terms of the bigger picture, there's never been more to talk about. There's never been more cross currents. There's never been more polarized. There's never been more energy and vibrations and volatility in the opposite ends of the spectrum. And this is kind of part of the bigger picture science that's happening in the planet, which is the secular picture. But from a macroeconomic perspective, as we look at the US, as we look at the Fed, as we look at the dollar, as the keys to what's going to happen going forward, I can say, wow, the disconnect between the media and even the Wall Street wannabes, and I say Wall Street wannabes, or the people they march on TV. I used to be one of them, but I never talked the book, but these people talk their book because the vested interest in being long stocks and having the stock market goes up is overboard. And the context you're getting is not necessarily always the truth, because we've also been kind of desensitized to having, dig deep, look at the data yourself, understand, what we're talking about in the details of the data, rather than this immediate gratifications, this attention span that's so shortened that we look at Twitter, see a headline, somebody wrote a little something about it, and that's the whole story, and that's what we go forward as the narrative behind us. Let me give you some examples. And I made a few notes, so I have these things exactly right, even though I probably could memorize all this. I do anyway. But CPI, it was amazing. And I wrote a piece 2 days ago, and I called it Celebrate Good Times. And if you remember Clue and the Gang, celebrate good times. Come on. And so this was a celebration in the stock market that CPI was like seemingly, contained here. And I was just shocked because my read of this number was anything but something to be celebrated. The monthly number was 0.4. Okay. It had been 0.2 for the 4 months prior to November. Then it jumped to 0.3, and now it's 0.4. Before that, it was 0. And prior to that, it was 0.4. So we saw, and one of the things we called last year too was you would see a decline in inflation. A lot of it was base effect. Food too. Food came way down. It was negative stuff like, beef and pork. And then you had, of course, the dynamic around energy all the way down to base effect. You knew that inflation was coming down. We said it would stay above target. It would be sticky around 3, and it would make a new low in the fall, higher low than the previous low, and turn back to the upside into the end of the year. And bam, that's exactly what's happened. And when you look at like the annualized rate of the monthly number, here's where you are. Okay. In February, 4.8. It dropped to 0 and negative in May and June. Then it rose to 2.4 and was there for 4 months from July through October. Then it jacked to 3.6 in November. Now it's 4.8 again. All right. That's the monthly number. No one really talked much about that. The year-over-year rate of CPI has gone from 2.4 at the low in September to 2.9. It's up 50 basis points. It's almost 100 basis points above the Fed's target, which of course is PCE, but so what? And we look at it, in the context of when you take retail sales, for example, which came out this week, all right, excluding vehicles, which in the last 4 months have made up 72% of retail sales growth, all right, but X vehicles, year over year is 2.9. Where's inflation? 2.9. That means real retail sales are flat to 0 if you want to take core inflation. All right. So that's kind of number one. Then let's talk about service price inflation, because this is all about kind of food and energy and some of the goods and durable goods and some of the things that got jacked way too high during the pandemic came down way too low, and now turning and flattening out and starting to rise again. Let's talk about the service CPI, and that's excluding energy services, which is really small. So it's not like you're excluding anything that's really important to services. The service CPI, yeah, it dropped this month in terms of its rate of change to 4.5 from 4.6. It's still twice the Fed's target rate of 2%. And not only that, there's 83 components. 10 of them are running above 6% year over year. A couple of them 7 and 8%. All right, but that's 12% are above 6% year over year in service price inflation. The number below the Fed's target of 2 is 11. That's 13%. It's like balance between 6% and then you're at or below target. And everything in the middle is skewed towards 4%. And the bulk of these 83 service price indexes are running at a 4% or greater year over year rate. This is the stuff people pay for. All right. Rent at 4.6. Hey, everyone's celebrating. Here we go. Let's celebrate good times because rent's only 4.6. Well, it's only using the word only because it was 8.1 in the high in June of 2023. So yeah, that seems like a victory. It's still 4.6%, and that's the biggest monthly payment of anyone's budget, is running at 5% inflation. All right. At any time prior to 2022, 4.6 is the highest inflation rate for rent in 35 years. So again, where's the celebration about that? Let's talk food, because food's a big one. Went way up, came way down. A lot of the food commodities got crushed, right? Well, a lot of them have come back up. Beef is at new highs. Hogs are breaking out. So you got pork. You've seen new highs in coffee and cocoa. You've seen a breakouts in a lot of these orange juices at a record high. Eggs are at a record high. Milk, butter. I mean, all these things, we track them. They all trade futures contracts. In CPI, the food rate jumped to 2.5. Right? It was negative, and now it's 2.5. Right? It's up. It was 2.2 in August. I mean, so this is kind of a new high. The PPI for food is 5.4. The PPI for food at the wholesale level is 7.9 year over year. These things are jacked. The import price for food for an agricultural is 9.7, and for all food is 9.2. Food is now 19% of our trade deficit. These are things that people don't really talk about, how important food imports are in this country. And now let's talk about California as a major producer of food. What's going to happen there now in terms of that? So we talk about all that, and it seems to me that you're still in a very difficult situation for the average consumer. And we see that in retail sales. Now we're starting to see some of these numbers are being tweaked. Retail sales, for example, eating and drinking establishments, to me, you go out to eat, you go out to drink. That is the primary discretionary spending. You have a feel-good factor, you're more likely to go out. You feel bad about your finances. That's where you're going to scrimp and save, is not by going out to eat, not by going out to the bar, whatever. All right. You're talking about 2.35, all right, rounded up to 2.4 was the year-over-year rate, and a decline for the month. A decline that we haven't seen outside the pandemic since 2014, $430 million in real dollar terms. All right. It's one of the worst declines in the last 35 years. So, and not only that, but they jacked the entire thing around the adjustments. So total retail sales grew by 3.3 billion for the month. You know that between the November, December, huge holiday, big seasonal adjustment. All right. But when you change the seasonal adjustments by 220% in eating and drinking establishments for no apparent reason that I could see, the change in the seasonal adjustment in sales at eating and drinking establishments was over 5 billion. All right. The net change in retail sales was 3.3. So you're talking about 5.4 versus 3.3. You're talking about a $2 billion, negative on retail sales. It would have been negative, the whole number. The only reason retail sales were up because they changed the seasonal adjustment in eating and drinking establishments by 220% from last year. So again, these things. Let's talk about employment numbers. We know the employment numbers are kind of faulty, and you have, again, big celebration last Friday, right? Because the employment numbers, private employment up to 223,000, much greater than expected. Out of that 223,000, all right, number one, part-time up 247,000. So there you go. That covers 223. Self-employed, unincorporated self-employed, up 141,000. That's almost the same as 223. And now get this. The educational attainment breakdown, people with less than a high school diploma, employment rose 170,000. Bachelor's degree or higher dropped employment 70,000. So when you take all of this together, we can say that the entire rise in employment was high school dropouts who started their own unincorporated businesses to work part-time. You want to celebrate? The only people celebrating are, Jeff Spicoli's parents. If you remember, the Fast Times at Ridgemont High. I mean, because this is Jeff Spicoli got a job, and that was the piece we wrote on Monday. We can talk about imports, and we can talk about a lot of other things. But, when you talk about the economy in the U.S., it's a disconnect from the actual numbers to the way it's being reported, to the reactions you're seeing in the stock market. This stock market is as extended and stretched as anything I've ever seen in 40 years of doing this. And I've called most of these crashes, man. This is one thing that I'm pretty good at, is seeing what's happening right now, calling it, and being prepared for what comes next. And it's just not going to be good, man. You've sucked every dollar out of this, and you can see how desperately they're trying to protect this market right now. And I think it's a losing proposition.
Yeah, Greg, I want to follow up and talk about the potential for a recession. I don't want to say that in a recession, commodity prices will not go down, but it seems to me, and from what you're saying, this inflation seems pretty sticky. Now, if we do get a recession, a downturn, sure, they'll come down at some point. But what do you think the odds are for a recession this year? I mean, it seems like that's what's needed to really trigger a real bear market.
Yeah, well, the first thing I would say is, yes, that's a possibility, and that's a risk, and that's something we watch. And today's move in copper would be an example of that. You have a tight situation in copper, and yet you have a contango that we haven't seen in years that doesn't match off against the inventories, even when you talk about, including Shanghai inventories. So that's a good question, and the answer is yes, that's a risk. But I would propose looking at it from a different angle. What if it's the rise in commodity prices that causes the recession, that tips everything over?
Yes.
I mean, if the Fed's going to take this,
I agree with that. Yeah, but
if
sorry to interrupt, but
this approach,
continue.
They're kind of acquiescing to higher inflation already. Why? Because, Jordan, it's all about debt. All right, and let's talk about the consumer in that context. Consumer debt, consumer credit, the Fed report just showed a drop of $7.5 billion in the most recent month. It's a lagged month, right? So it's November data. That's rare. You don't see consumer credit fall, all right? Most of it was revolving credit cards. Delinquency rates, 10.6 on delinquency rates on credit cards. Auto loans at new highs. You're talking about a consumer that is stretched, that is struggling, that is stressed, and really it's been becoming harder to make ends meet. And if inflation hadn't come back down, we'd be in a recession already. But if you start talking about going forward, all right, we have just gotten all this data that says the consumer is stressed out here, okay? And at the same time, if you get another rise in inflation, how are you going to support growth? The potential capacity or the willingness of consumers to keep borrowing on their credit cards at 30% interest rates just to pay the bills. I mean, you're going to start to see a lot of S hit the fan. Why is this? It's because there's just too much debt. You want to talk about Trump coming in, it's like a Reagan revolution. Paul Volcker defeated inflation. We had this huge, bull market in the economy and in stocks till 87, right? The problem is Volcker and Reagan had no debt. We have so much debt. And the way you can look at it is very simple, and it's not simple because when you complicate it, it looks even more problematic. But the bottom line is, the most simple way to look at it is GDP in dollar terms versus public debt, which is federal government debt in dollar terms. These two things ran pretty steady along to each other, where GDP was outpacing government debt until 2009 when they started QE. Everything changed from there. Now you saw that debt rose and came kind of up to where GDP was, and then from the pandemic, it just blew through. It was really 2018 when the Fed came with their new paradigm and policy paradigm and 11 white papers, 300 pages. I read every one of them. That was a big deal when Powell said we're going to let inflation run to an 8-year average of no tolerance band, so on and so forth. And then, of course, the pandemic blew it out. So right now it takes $1.26 in new debt to create $1 of new GDP growth, right? You want to throw consumer and household debt onto that. Now you're talking about $1.86 to create $1 of new GDP growth. That is when you have entered the debt black hole. That line was the macro event horizon line. It's the place where you enter a black hole. You really don't even know it yet, but it's already, the gravitational pull is already too much. You cannot escape. No matter how much propulsion you can generate, you can't escape it. And that propulsion is printing and burning new money, which is what they're going to do. And that's the case for gold. But in the terms of the economy, yeah, it's a sour picture. And I don't like to be a gloom and doomer because I think there's great opportunities out there for sure. And certainly in this environment where there's such polarization and violence out there, it's like, hey, just put me on a jet ski out in the middle of the bay, or put me on a golf course where I'm in nature and I don't have to worry about any of this stuff. And there's still joy to be found in life. But at the same time, when I see what I see, and I've seen it before, and it has been a progression to the point where now you've crossed over the hole where there's no return. And what it is it's an erosion in the standard of living. And that's what we see in other countries, and that's the path we're following.
Yeah, it's not good. So, yeah, and I agree with you, by the way, that commodity price, because they're starting, they're starting to rise again. And I completely agree with you that at some point that rise can tip us into recession. I think similar, like you had that in 1999, like you had a brief rally in commodity. I remember oil had a pop there, I think into 2001, if I have my dates correct. Same thing happened in 2007. Remember we had that, looked like we were going to go into recession.
Crude, yeah.
Then we had that, then we had that big, the Fed started cutting. We had that big move in the first half of 2008. They were talking about, they're going to be hawkish. They're going to cut rates. So I completely agree with you on that. But my question would be, what can we look to in the markets that would tell us that this recession and like major downturn is starting, or at least could happen soon after this happens in the markets? Like what indicators or what markets could tell us that?
Well, I mean, that's a great question, and it's a tricky answer because the answer isn't the answer. All right, so we're going to give you a trick answer to a trick question. It's not a trick question, but I mean, the stock market will tell us. Of course, the stock market is not telling us now, and it's already happening now. So, you get enough data that's above ground where people can say, look, things are okay, right? You have to dig below the surface to get these data points that show us where we are, and not everyone's digging below. It's just one of those things people don't do, and thank God it gives me a job that I can have, right? But so I think the stock market is the thing that has to bring it above ground where people can start to see this. And I think that if you actually take the Fed's position and you listen to what the Fed has said in like the beige book or the meeting minutes, there's a lot of nuance in their comments. And I really love dissecting the comments these days because there is this nuance where it's kind of like they're saying, but the stock market and asset prices are still fine, right? Maybe they want disinflation there before they start declaring victory over inflation, because this is kind of what keeps it going, is the fact that you keep having this wealth creation in stocks. Now, we know that has become much more narrow. Absolutely. All right, that's the fact. We also know that I think AI has run its course, all right, in terms of, hey, we've had this big run, you've anticipated all this growth, but now what you have to do is get that growth into products that consumers and businesses can buy, and that's going to take some time. So you have this kind of window where you could get a correction, and technically, it's correction all over the place, especially when we look at upside leaders like NVIDIA. All right. But then when you take, like, even I was just looking at this today too, take food stocks and take the restaurant stocks and take some of the things that are linked back to the consumer that all of a sudden have had great performance are getting wasted and are breaking long-term trends. Some of them go back to 2008. Stuff like ConAgra and General Mills and, even some of the restaurant stocks. So when you look at that, even Wendy's, even McDonald's. I mean, if people are going to cut spending at McDonald's, they're hurting, man. So to me, that's a sign right there. I think that the way to look at this is, though, because the bigger risk to this whole scenario is that you have a recession that cuts demand, which drives commodities lower. I also would say that some of these commodities, particularly something like copper, when you look at the swap rates, they're already priced for a big demand drop. You know, it's almost like copper came from $5 all the way back down to $4. Based on that, that hasn't even really happened yet. And in that context, the more important thing to note is the dollar, because the dollar card will be played absolutely, whether it's the U.S. that plays it, whether it's China, Russia, and OPEC that plays it, or it gets played in some other way that we might not see coming. All right, let's consider Trump trying to remove all the illegal immigrants in the country. All right, these people are occupying apartment complexes and are armed to the teeth. Do you think this is going to be easy without casualties, without collateral damage, without, innocent people getting hurt? This is going to be like a war if they really take it on the way he's, proposing to take it on. I don't see how this is peacefully done everywhere to begin with. So you have that risk too. But when the dollar goes down, commodities will go up, and it doesn't matter if there's a recession, because they'll be pushing the dollar down to try and generate some inflation in the economy. You'll just see it first in commodities.
Yeah, just a quick follow up on that, based on what you're saying. Yeah, maybe we could see at the beginning of the downturn, you see a decline in commodities, but then immediately when they start to fight it, and even as a downturn is still occurring, commodities could then, led by gold and secondarily silver. The commodities at that, I'm just thinking out, maybe they get hit at the very beginning, but only one time, and then they diverge and potentially start moving up as policymakers get really aggressive to try and fight the downturn.
Yeah, I mean, that's what happened in 2008, 2009. It could definitely happen again. It's the biggest risk to gold is that, you see all asset prices go down. And I think this is a bigger risk to crypto right now, because Bitcoin and even Ethereum, these have gotten this last juice to the upside from Trump. Yeah, but that's all kind of predicated off what happened in 2024, which was ETFs. And it's like, okay, Bitcoin and Ethereum, they want to be different, right? But the big thing they wanted to do was get an ETF so we can be in the stock market. That's not different. All right. Now it tracks like a risk asset. It does not trade like a haven. So I think there's more risk to, something like Bitcoin, Ethereum, and all of crypto in that context, maybe from much higher levels. I mean, I'm bullish right now, but I think that that's a big risk. But I would also say that, again, like, I think when you look at what the yield curve is doing in the U.S., and this is another big call we had last year that we really nailed, and there was plenty that we didn't nail. So, let's be fair. But it was the yield curve. Why? Because they're going to acquiesce to higher rates of inflation. They have to protect growth because the debt deflation is so much worse. They know it, and they will do. I wrote in my book in 2006, when peering into the deflation abyss, every central banker on the planet will choose to reflate at all costs. And those costs are higher gold, higher inflation, a lower dollar. Ultimately, we will take the lead in this. Ultimately, I just, seeing how that plays out, I would say that I'm kind of surprised it hasn't played out already. I really am. But I also see, and I saw this in, I remember seeing this big time in 2007 and 8 with Germany, with the German DAX too. There's levels where just buying comes in huge, and you see these spikes in the stock indexes, and they're desperately trying to protect it. And I've seen this in currencies with central banks intervening. I've seen this my whole career. People say, they're manipulating the market. It happens all the time, man. So of course they are, but it never lasts and it never works. And when it's like holding the beach ball underwater, when they stop doing it, the beach ball explodes up to the surface.
Greg, quick question. When is gold against the S&P 500 finally going to move and break out? Because I know people are excited. They look at, gold's, outperformed the stock market since 2000. Gold would outperform the S&P last year. But if you look at gold, a chart of gold against the S&P, it's still, it doesn't look like shit, but it doesn't look bullish. We gotta get that thing breaking above 0.50. I know you watched that. I mean, I know you don't have a crystal ball, but tell us when that.
No, I mean, we've liked the ratio, and it hasn't worked out. It's been even worse in silver. The silver S&P ratio, and frankly, there was a period just recently where Bitcoin was making a new high even against gold. So, you could point those things out. Again, it's a tough one because what I think you need to see is a rotation of capital out of the leaders, tech, and some of the things that have led into precious metal stocks. And you got a little burst of that. And if you remember, we talked about this even on your program here, that when it was kind of reversed, because at the beginning, second half of 2023 and into early 2024, it was the small caps that were leading the way, that had the best performance, that had some breakouts, had some new highs. Whereas Newmont and Barrick and Anglo Gold Ashanti were all like breaking down and acting terribly, right? And I said, once the big caps start to turn, it'll be like a reverse tell. The way it used to be would be the other way around. When the juniors start to outperform, that's the frothy part of the market. No, because now it's like when you start to see gold get valuable enough where the gold in the ground value goes up to a company like Newmont that has, taken on debt to take over some of these companies because they can produce the gold, where that company really was never going to be able to do that to a maximum efficiency. And that happened. And now, obviously, more recently, that's completely pancaked and gone the other way. So I don't know, man. I mean, it could be a case where you see, and I think maybe more important even to watch for now would be the gold price against the GDX to see, like, this could be a case where gold rallies and it doesn't help the stocks as much as it should because nobody's buying them. I don't know. I don't think that's the highest, probable scenario, but it's not a zero probability.
Yeah, I mean, just looking at charts, it seems like maybe that could transpire here in the first quarter or the first half of the year, maybe until we get some kind of turbulence. I mean,
I think so.
I see that happening.
Yeah, I mean, I agree with that. I do. I mean, I think that's a call. And I think when you see some of the things that are breaking down, and even with the food stocks that I was just mentioning today, I mean, some of these stocks, they're still widely owned, like the on-balance volume, the volume versus the rate of return. I mean, the rate of return is diminished to where some of them are flat to negative on a 52-week basis because we've kind of gone sideways now for a while. People don't really realize it. And all of a sudden, your rate of return is not what it was. The price starts to go down and everyone owns it. All right. Every passive investment, every mutual, every person owns some of these, especially the high flying tech stocks. Who's going to buy them when the things are tanking and you turn around and you have a liquidation going on? So I think that this is the kind of thing that still is laying in wait. And I think that's kind of the next step for me in this whole process because, and the other thing would be, of course, the dollar and tariffs. And, if this thing boosts the dollar, that's the worst thing for stocks. It's the most reliable and longest running and tightest negative correlation. All right. Dollar up equals stocks lower. Dollar down equals stocks higher. It works for almost every country and every currency, but the relationship in the US is so tight. And right now the dollar's rally to 110 is implying 5,000 on the S&P, where it's closer to 6,000. So these kinds of things to me lead me to believe the next big move is going to be some kind of correction in stocks. Now, I'm not saying it's a crash. I kind of think it's going to be a kind of a bigger correction, and then they're going to try and save it. It goes sideways, and it kind of just bleeds. It's like a leg wound, man. It just bleeds you out, and then they try to get a kind of counter turnaround. It just goes sideways for 2 years. Then what? That's when you might see people going into the gold shares. That might be the time when it shines, not in the initial phase, but in the next thing where it doesn't rally, it doesn't respond to Fed easing the way it has in the past because there's too much debt. And that keeps the stock market under wraps. And that would end up being, I think, bullish for the metals because they will keep trying to work the dollar lower.
Speaking of debt, one more thing I want to touch on, which I don't think you've mentioned. I apologize for not asking you about it sooner. The 10-year yield, long-term bond yields. I know you have lots of analysis and opinions on that.
Yeah.
That 10-year yield getting pretty close to 5%. I mean, that's not good, Greg.
Right. Well, I mean, honestly, it's funny because people are kind of scratching their heads. And I saw one article on Bloomberg today, and actually the woman was even on TV after the article, talking about how, bond yields have risen when the Fed has been cutting rates and so on and so forth. And it's like, well, duh. I mean, does that not, and the yield curve steepening? I mean, that's just smacks of the Fed's acquiesced to higher rates of inflation to protect growth because they have to because of debt. But at the same time, the bond fundamentals are not bullish other than a potential recession. Bond fundamentals are bearish. The Fed is not buying, okay? Japan has turned seller to some degree, and they have a big amount that they could sell and repatriate to support the yen and be kind of stealth intervention in the yen, all right? And they don't really necessarily want that right now, but that could be a play in 2025. China's dumped 40%, 50% of their bonds, right? All these countries, as we haven't talked about BRICS because it's kind of taking a back seat because Trump's kind of dethrottled that. That's not going anywhere. It might gotten pushed back a little bit time-wise, but that is still full force in my mind. And when you talk about all these places that have trade with China and all the currencies and how the blockchain would allow you to tweak the part of the BRICS unit that you would use to, so you say, I'm going to be Vietnam, I'm going to trade with Thailand. Well, you use the dong and the baht instead of other currencies, and you could tweak this with every trading partner this way by using the blockchain to do this, right? Still backed by gold, still largely renminbi and ruble and real. But in that context, that's more bond selling. Right now, Brazil is kind of backed off from selling bonds, and we've seen this move. But this is, this is kissing Trump's ring, and no one wants to be on his bad side right now with the threat of tariffs and all this. Let's see what this looks like a year from now. In that case, so I think from that perspective, let alone the deficit. Oh my God! Now the proposed budget now for the next 9 months, because we're 3 months into the 2025 fiscal year, $710 billion, by the way, in the first quarter of the fiscal year in debt. That is 39% higher than a year ago. 39%. Of course, that was largely to try and buy the election for Kamala, but it didn't work. But then we talk about this year, the budget deficit's pointed at 1.86 trillion. All right. Borrowing from the public is 1.91 trillion. Second year in a row, they will borrow more money from the public than the deficit is, let alone the fact that what they're doing is we are borrowing from the public, okay? Then we're, printing bonds and printing these dollars that are, paid on these bonds, and then we sell the bonds back to the public. And then we're going to pay them with the dollar that buys them less. At some point, that has an impact, and you'll get to a yield level, I think, when, people will buy bonds again, but that may be a lot higher than where we're at. So to think you can't have a bond market crisis here, that maybe the type of thing that people have been waiting to see in Japan for 20 years, for crying out loud, maybe that happens here. I'm not saying that will, because, you have monetary Armageddon. Here is, again, the base case for gold. What do? They're staring into a deflation abyss because bond yields are rising because no one will buy them. They'll buy every bond they ever printed. And we call it monetary Armageddon. I talked about it in my book in 2006. You have the two, the general and the president, turning the keys simultaneously, Treasury official and Fed official, and they blow up every dollar debt ever printed, and a loaf of bread costs $50, and gold's at $5,000 an ounce.
If a loaf of bread costs $50, I mean, I think gold would be more than 5,000.
Probably. Maybe I had the gold bread ratio a little off there, George. That's a good one.
But yeah, a quick follow up, and then I want to talk about your report. My quick follow up, and again, I don't want to put thoughts in your mouth. It seems like for gold, and I'll throw in silver in the mining stocks as well. It seems like we're getting really close to the point when, and again, based on what you're saying, it looks like they could really take off, when the shit hits the fan, so to speak, or the next downturn, when we get in the middle of that and they start, printing money again. It seems like that could be when they really take off. And so therefore, I mean, I'm not pressuring the listeners out there, but you got to be in before that. Like you can't wait for that to happen, because too many people are going to sit on the sidelines. They're going to wait. They're going to get worried. They're going to get hit a little bit, and then the sector will rally. It'll keep rallying. People will they'll just be shell shocked and not be able to get in. And so, I know I'm just droning on here, but to me, based on everything you're saying, because my thinking, okay, what does that mean for markets? Well, when that hits, that could be when precious metals really start a vertical move. And again, you and I, we're not doomers here, but to me, at least that's how I see it based on what you're saying.
It's kind of already happened. I mean, if you really look at where we've come from below 2000 to where we are at the high last year, first of all, majority central bank buying. Okay. ETFs. I mean, they were selling in ETFs. Coin demand was down. You can see the futures market open interest is, got some bumps, but it hasn't been anywhere near where it should be for this kind of price move. It hasn't been a U.S. investor, a Western investor led move. There's been central bank buying. It's been Asia. It's been, everything but. So to me, and that's kind of like we talk about, rolling out other stocks into the precious metal stocks. I agree with you. You can't wait to be involved, but it is already a move where people are chasing it but they haven't even started chasing it yet, right? Because that's what I said last year. What you just said is what I said. Look, you have all this that's not being led by the public. It's not speculative at all. When that starts to develop, holy mackerel, this thing's going to take off. And now we're here, and it still really hasn't happened. What I will say is, and it's disappointing action today, but this latest little blip in gold to, where the futures went back above 27.33, which was a key level, you had a bigger rise in open interest than you did during an entire $40 rally previously, right? So there is a pickup in demand, if very subtle, but if you watch this thing as closely as I do every day, you notice things like this. And so to me, that's really interesting, because that could be the very tip of the spear of exactly what you're talking about, because people are a little afraid. Trump and tariffs. I mean, you're going to kick out all the illegal immigrants. You're going to have to, basically blow up apartment buildings in Colorado to get these people out. I mean, how's that going to play with the stock market? Not very well. Where can you protect yourself? Yeah, there could be a rush to that for a variety of reasons. I mean, the fact that the Middle East has played out, I don't want to say peacefully, because that's, really insulting, but, to the degree that it hasn't blown up the markets is kind of mind-numbing to me, that this has happened in crude oil at its top risk level was $80, in WTI. So there's all kinds of different things, I think, that could spark that. But, I am a CTA. We do manage money. And, of course, it's risk aversion all the way. And when you're at $3,000 an ounce and it's a 100-ounce contract, managing the risk is a lot different than when it was $2,000 an ounce, excuse me. So, this is why we do what we do, because we're almost assured, nothing guaranteed, because, I could mess up and miss the move. It's happened before, but, pretty insured, a really high degree of probability that we're going to be involved if that happens. All right. In the meantime, protecting the downside, because the downside, could be significant at a time. And I think there's part of this is that people that feel burnt by gold and silver, believe it or not, especially silver, I kind of believe that a little more and understand that a little more. It is frustrating, no doubt. But to the point where it's kind of like, well, this stuff's never really going to go, and so on and so forth. And then by the time, they realize they missed the bus and they're running down the street and there's another bus coming, they're going to want to jump on it, no matter how painful it might be to be dragged to the street a little bit. I don't know.
Yeah, Greg, as we close here, a couple of things. But first thing, I know that you have a report, your outlook for the year. Can you tell our listeners about this report and where they can go to get it?
Sure. It's called Crossing the Macro Event Horizon Line, which is all about the debt, all about the consumer, all about the economy, and particularly about stocks, and looking really at the tech stocks in the U.S., the chip makers, the XLK tech, and you kind of see this rollover in all of the momentum. Momentum's very negative right here too, by the way. So it kind of covers gold and silver too. So it does a good job of covering everything outside of some of the food commodities and all this. So the best way to get anything or any information on any of the business here is to email me directly at Greg Weldon, it's GregWeldon at Weldon Online, one word, weldononline.com. And I'd be happy to send you that report, give you a quick free trial to our Global Macro Strategy Report, which is our key research product. And then, of course, I encourage your listeners to check out our podcast. And we've been doing a podcast. We're into season 3 now. Most recent episode was Crossing the Macro Event Horizon Line. So you can hear some of this stuff too. But you really want to see the charts. The charts are eye-opening, even for someone like me that loves charts and looks at them all the time. I mean, this is why I'm excited to show it to people, because these charts will speak. The visuals are more impressionable than me sitting here talking numbers all the time. It's just a lot of people don't absorb numbers that well. You'll absorb these charts for sure. And the degree to which going forward, passive investing in stocks is not going to keep pace with the debasement in the purchasing power of your paper money, your wealth and income. We've seen this in every country that has to go through this with huge debt. We're there. I mean, you want to take household debt and public debt. We're at 186% of GDP. That's and rising. That's always a crisis in history, and we're kind of there now. So in that context, you're going to have to do other things. And people that do what I do as CTAs that can trade the futures, that have experience, and I'm doing this 41 years in all the commodities, the energy, the agriculturals, the industrial metals, the base metals, let alone bonds and currencies, going to be huge opportunities there as well. And then, of course, we can be short the stock indexes. And the way we do our programs, there's no money commingled. We have a high minimum because the risk is so high, and I'm a low risk guy. So this is all back engineered to where the minimum is a function of our risk overlay. The minimum is $1 million. So someone would theoretically need to have $5 million in investable money before we'd be even willing to talk to them and to see if we're a match, because a lot would go into something like that. But we are accepting new money, which is a rarity. We don't usually do that. In our returns, I mean, we really hate to talk about returns in public forums, but it's north of 20% annual over the last 6 years since we tweaked our program and exposed it to the commodities and the whole 9 yards and took it to $1 million. Money's in the, this person wants to open an account with us. It's in their name. We have no control over the money. It's no, there's no Bernie Madoff down here in Palm Beach anymore. He's dead, I think, right? So we set it up so that it's so transparent that is foolproof in the sense that you're not going to get ripped off and you're not going to be on American Greed. And I love that show. I really do, because I can't believe people actually do that to people. It's mind-blowing. And you get a report every morning. You see every morning, every dollar, every risk, every commodity, every position. And it's a 48-hour turnaround. We don't have lockup periods like some of the hedge funds, 1-2 years. You don't like what we're doing, you're not comfortable, I'm not comfortable. The money turn around 48 hours. You can't get any more transparent than that. And we get most of our income from performance.
And so to learn more,
Greg Weldon at weldononline.com.
Okay. And yeah, but the narrator on American Greed, that guy's a hell of a voice, by the way.
Stacey Gates, man, he's a legend.
So Greg, before I let you go, anything else you want to mention?
Man, that's a good question. I mean, yeah, I just believe that if you really see the science, what's happening with the science overrides everything. When you understand frequencies, and it gets a little heady, and people think of hippy dippy, tune in, drop out, it's kind of a Timothy Leary type of stuff when you start talking about the science that's going on right now, right? Where the solar system is traversing, Orion's arm in the Milky Way. It's a 25,800 year orbit as part of the arm's 230 million year orbit around Sagittarius B, the black hole at the center of the universe. What's happening is, because we're in a place now where there's a lot of stars, a lot of systems, there's a pulsar, there's a supernova from 400 years ago. I mean, there's a lot of light hitting the planet. Light is pure plasma energy. It is heating the planet up. It's not global warming, it's solar warming. NASA has changed the actual moniker of this whole thing because it needs to be. And now Neptune has moved in conjunction with all of this, where the ice shelves are melting there. There's organics we found there too. The bottom line is everything is more electric, more elevated, more polarized, vibrating at a higher frequency, right? The Earth now, 7.83 hertz was the frequency of the vibration of the planet for thousands of years. That we measure this through geological technology that blows you away, right? The human heartbeat, 7.83 hertz, aligned with Mother Earth, right? Until this period now where the Earth is spiked to 8.29. And you see people disconnected, it's because they are literally disconnected energy-wise. They're in conflict with the energy of the planet. And you can see people, animals acting out weird. This is all about the weather. All of this is based on science that's going to get worse before it gets better. And that's all the reasons to do the things that I'm talking about doing, about protecting your money, income, wealth, because down the road, again, not a doomer and gloomer, but you see the unraveling of the fabric here, man. Don't ignore it, because it's science and it is happening and it's going to continue to happen.
Okay, Greg, you're the best at this. Love your macro analysis. Thank you so much for coming on, as always, and hope we can talk again later this year and see how everything is developing.
Sure. It's my pleasure, Jordan. Always happy to contribute. Do a great job. So kudos to you as well.